ready. You get started.
Well, hey, I appreciate you coming in today. Thank you for taking the trip. I know it took about an hour to get here.
Yeah, no problem at all. Yeah, caught the train to avoid like the mess of traffic. Was actually able to get a little bit of work done on the train. By the way, I'm Darian Veal, Realtor, Exit Realty. This is my good friend Jonathan Volpe with
Yes.
Neighborhood Loans. We will be discussing, primarily we'll be discussing DSCR loans today and also mixed use, which I feel like a lot of people are, I want to say uninformed, but I feel like it's just something that's not discussed as often.
Absolutely. Both of those programs are not well known
Okay.
in real estate game today. I mean, there's a few people that use it as a niche, and that's exactly what we want to get out today is DSCR program, mixed use. Which one do you want to jump in first?
Let's do DSCR first.
DSCR, awesome. And you know what? Hold on. I am going to look this up, which we can do this right now. So.
Okay.
Okay. So DSCR. What does DSCR stand for? It's debt service coverage ratio. So what does DSCR stand for? Debt service coverage ratio. Okay. So with DSCR, the biggest how do I want to say this?
Advantage, maybe? Or...
No, not advantage. The biggest qualification for a DSCR loan is making sure that the rental income for that property covers the debt that comes with the property, which is going to be principal, interest, taxes, and insurance. So as long as the coverage ratio, which means the rental income, covers 100% of that PITI, principal, interest, taxes, and insurance, they will allow the loan to move forward. So to give a full breakdown on DSCR, there is no income calculation from the borrower's employer or self-employment. Okay? We do not care about any of that. Minimum credit score drops down to 640. Okay? Minimum down payment is 20%. That is for 1 to 4 units.
Okay.
And anything 5 to 8 units is going to require 25% down. Okay? So how they calculate whether this property will qualify for financing or not is when the appraisal is completed, as long as the property value is there, and they do what's called a rent schedule. That rent schedule is going to find properties in the area that are similar and find out what they're currently bringing in rent. As long as that rental income covers 100% of the PITI, you can move forward with the DSCR loan.
Gotcha.
Okay. So this program is big for investors or new investors. Okay. It also is big for people who like to flip properties. Okay. A lot of them want to be in and out. This is something that doesn't require tax returns, profit and loss statements, documentation from your CPA, verification of employment. These are all additional things that some consumers who like to move very, very quickly with investment properties want to be in and out. They want to close as quickly as possible. They're not too concerned about that slightly higher interest rate you might take. So they qualify for DSCR loan. A lot of them put renters in there, keep it as is. A lot of them will put money into it, flip it, sell it, move on to the next.
Okay, gotcha. And so you just brought up something that I wanted to hit on. Interest rate. Are we looking at around the same interest rate as we would if we were going, conventional FHA, slightly higher, slightly lower? What's the interest rate look like on top?
Great question. So I'm sure this can cause a bit confusion, but with today's market, okay, and this only can last for, or this comment is only good for today and the next potential day with the way rates move, but it's always slightly higher than FHA and conventional. So for instance, if you're getting a quote for an interest rate at 7% with conventional, FHA is typically a little bit lower than that, maybe 6.75. DSCR can range anywhere from 7.5 to 8.5%.
Gotcha.
Okay, so it's always going to be a 0.5% to 1% higher than typical FHA and conventional mortgages. But for a lot of people, who are self-employed, they don't mind paying that additional interest because they may write everything off
Right, of course.
and don't qualify for a typical conventional or FHA loan. So in the grand scheme of things, it is still a competitive interest rate.
Gotcha. And then, is there a, I know with, like, for example, FHA loans come with a, I guess, a purchase price limit based on the size of the property. Be it single family home, 1 to 4 unit. Is there a purchase limit?
Sure. Yeah. So we do have a multiple DSCR programs that we have. I'm gonna start that from the beginning. Okay. So we do have multiple DSCR programs with different servicers that we have, but it looks like one of the limits for 1 to 4 units is 2 million.
Okay.
Okay, which is a pretty large number. There aren't many 4 units that are going for 2 million in the Illinois area, but so it does give you quite a bit of buying power.
Gotcha. Okay. And then, so with the DSCR loan, is a buyer allowed to, what am I trying to say here? Can you own or occupy that? Do you have to own or occupy that? Do you have to already have a primary residence?
Okay, so we're going to rephrase your question just because the owner occupancy being primary residence, when I gave our speech, you can own or occupy it, but it's technically frowned upon. So we want to kind of leave that portion out. But what are the requirements for the DSCR? That's a great question.
Okay.
And then asking, do you have to own a primary residence? That's a great. So we'll rephrase that. Go ahead, and then I'll answer.
Okay. So what are the requirements to qualify for a DSCR loan?
Great question. So most DSCR programs do require you to own your own primary residence, whether it's a condo, single-family residence, or an existing multi-unit. Okay. Most DSCR programs, in addition to that, want you to have ownership or have had ownership recently with an investment property. Okay. So if you own a condo and that is your investment property and you departed from that condo, purchased yourself a single family residence, now you qualify to purchase with the DSCR program.
Got you. Are you allowed to own or occupy this particular investment property with a DSCR loan?
You know what? Let me look that up just because I do want to answer that question.
All right, sorry, I don't mean to ask you.
No. You're good. Can you? No, can you own or occupy a DSCR loan in Illinois? No, you cannot own or occupy.
Cannot own or occupy.
Correct.
Okay.
These are designed for investment properties. Okay.
All right. So let me ask again.
Yeah. We'll go ahead. Yeah.
Okay. So are you allowed to own or occupy a property that you're attempting to use a DSCR loan for?
So DSCR loans are for investment property. They could be for business use, meaning they can be held in an LLC name or a business name.
Gotcha.
You can hold the title personally in your personal name, but they are for investment property use.
Gotcha. And so with investment property, that means a buyer could potentially do Airbnb or Vrbo also?
Absolutely, yeah. So they're great for Airbnb and VRBO. There is a calculation that is used if it is going to be Airbnb or VRBO. They will take the rental income from the total year, which is similar to a rent schedule. So they pretty much do a rent schedule for Airbnb, VRBO. They take the higher months, okay, that it will rent out, and they amortize that over a 12-month calculation to come up with a number to make sure that that average 12-month rental income will cover PITI.
Gotcha.
Okay.
Gotcha. Okay.
So it is very, very big with Airbnb, VRBO.
Wow. Okay. Wow, that's good stuff. Yeah, I feel like a lot of clients, a lot of people I talk to just aren't aware. Like, I hear it mentioned every now and then, but I don't. I hear more, especially with investment properties. I hear more hard money loans. I know FHA will allow you to do multi-units. Obviously, you have to own or occupy, of course.
Yes.
But yeah, I feel like DSCR is just not something that's is talked about. So yeah, so thank you for the thank you.
No problem.
Yeah, thank you for that information.
Absolutely. It's really big with self-employed consumers.
Okay.
Self-employed consumers, it's a double-edged sword when you're filing your taxes. The more money you show you make on paper, the more you pay Uncle Sam. And then the more you write off, you don't pay Uncle Sam, but then that's where that double-edged sword comes in for the financing portion of it, okay? Gotcha. A lot of self-employed people, though, they're able to take that money, save it. That savings now gives you your 20% down payment to purchase your investment property. So it becomes very, very popular with self-employed consumers because they don't have the tax returns to qualify for a mortgage. So that rent ratio is what's very, very helpful for them to qualify.
Gotcha. Okay, all right. It's good to know. So do you want to go into mixed use?
Absolutely.
Yeah, mixed use next.
Yep.
So just right off the top, what are the main qualifications for mixed use? Well, here, let's back up. Do you want to kind of give a quick explanation as to what mixed use properties are?
Yeah,
for those who may not know?
Yeah, there you go. Just say, hey, John, what is mixed use?
Hey, John, so we're going to talk about mixed use now. What is mixed use? What is a mixed use property?
Great question. So mixed use is going to be a square footage difference between residential space in a property with commercial space. So for instance, you could have a 2 or 4 unit building, and in that 2 to 4 unit building, there can be a variance of residential units and commercial units. So it can be 2 residential, 2 commercial. It could be 1 commercial, 3 residential. That percentage could change based off of the particular property that you're looking at. But what it will allow you to do mixed use is occupy one of the residential units and also own or rent out the commercial space to another business. Okay, I know that's going to open up a lot of questions, so I'll kind of dive in here to the difference between what FHA requires from conventional. Okay,
Gotcha. Okay.
So FHA has some pretty strict rules with mixed use. They allow up to 1 to 4 units or 2 to 4 units for the mixed use. FHA requires you to occupy one of the residential units. They do not require you to own or occupy the commercial space. You can rent that out.
Oh.
Okay.
So in theory, you could occupy one of the units and then rent out that space to somebody who wants to open a dance studio, somebody who wants to open a barbershop, insurance agent, anything, right?
Anything along those lines, correct, yes. And there's multitude of businesses that can be opened up within the commercial square footage. Okay. Here's where FHA is very strict. The residential percentage of that building has to be no less than 51%. Okay. And the commercial space cannot exceed 49% of the square footage. Okay. So just that 1% can tip that building from qualifying FHA compared to conventional.
Okay, so that would lead me to the obvious question: who determines? How do you determine what's 51-49?
Sure, great question. So the appraiser that does the appraisal on the property is the one that determines the square footage percentages from FHA to conventional. So appraiser is going to get the full square footage of that building and measure out exactly what is deemed commercial compared to residential. Now, most of these buildings are perfect square,
of course,
or a rectangle. Okay. A lot of the times they're mirror image from the bottom floor to the top floor. What pushes most of these buildings 51% towards the residential space is any common area in that building can be deemed residential. So for instance, if you walk into the building and you have a staircase going up and then a door going to the commercial space, that small square footage, that is a common area that will lead you to the commercial space and up to the residential, can push you from 50-50 to 51-49.
All right. Well,
with FHA, that's a big help because you're putting 3.5% down. on a 4-unit building that is going to generate a ton of rental income for you. You're going to occupy 1 unit, and technically you're going to live rent-free.
Right, and so I don't want to get too into the weeds about how rental income and qualifying and things like that, but are you allowed to use the potential rental income from the commercial space to qualify for the loan? I may not be asking that.
No,
question.
you're asking properly, yeah.
Okay.
So they do not allow you to use the rental income from the commercial space to help qualify to purchase with FHA.
Okay.
But you are allowed to utilize the residential units as rental income to help qualify. So for instance, if you're finding a 4-unit building, 1 is commercial, 3 are residential. Okay, you're going to occupy 1, so you're going to use the 2 other residential spaces as rental income. So if those 2 other residential spaces generate $1,200 a month in rent, you can utilize $2,400 a month to help you qualify for that property. Now, FHA does only utilize 75% of that total rental income, but it's still a very, very big help.
Yeah, absolutely. And so, next question: what are the qualifications? How does someone qualify to get a mixed use loan?
Mixed use, yeah. So,
I'm sorry, not to cut you off.
Yeah.
Let's go FHA first,
Okay.
and then we'll flip to conventional qualifications.
Okay, so for qualification on a mixed use building, it has a very similar process to just qualify to purchase a home. We make it very, very easy when you apply through my digital portal. It'll request all the personal documents to upload, which is going to be pay stubs, W-2s, bank statements to make sure you have the money to qualify for the down payment percentage. If you are self-employed, it does require 2 years tax returns. What I do is a full credit check. I analyze the income, calculate it, make sure we have it averaged over 12 months or 24 months, depending on how you are employed. As long as your debt to income ratio is under a specific threshold and your down payment percentage is verified in your bank account, we can qualify you for a mixed use program.
Wow, that's amazing. Okay, and then what about credit score?
Credit score, yes. So credit score stays the same. It's consistent with FHA. It is 580.
580.
Yep.
So you can qualify for a mixed use loan with a credit score as low as 580.
It's 580. Yes.
Right. Obviously, as long as all the other boxes are checked.
Are checked. As long as the other boxes are checked, yes, 580 is credit score. It's great for consumers who might be living with mom and dad, but just opened up a hair salon, or looking to open up an insurance agency, State Farm, American Family. You see them on every other block, multiple of them. Those are just 2 examples to where you can then occupy your own space upstairs, and your business is right below.
Yep. And then what about conventional
Yes.
qualifications?
So conventional qualification for a mixed use, slightly different. Okay. Minimum down payment is 5%. Okay, that's for 1 to 4 units. Minimum credit score requirement is 640 and above. Okay, conventional requires you to own or occupy 1 of the residential units. Conventional also requires you to occupy the business. So you have to be the owner of the business and move your business into that commercial space. Okay, here's the big difference between the FHA and conventional is the percentages of residential compared to commercial. Okay, you do not have a requirement like FHA does. The commercial space can be greater than the residential space as long as you're occupying 1 of the residential units, and the commercial space does not matter what those percentages are.
Gotcha. Okay. All
Yeah.
right. Well, that's good information. So we talked about DSCR. We talked about the mixed use. Why don't we? I feel like FHA and conventional loans and things like that. I mean, we hear that, we get that sort of information all the time. We want to dive into, 2 to 4 units a little bit. Just
Yeah.
kind of, while we're here, I guess just talk about what does someone need in order to qualify to purchase a 2 to 4 unit property?
2 to 4 unit. Well, such a great program. I think it's the best way for anyone to live rent-free is a 2 to 4 unit, which can be a totally different conversation. But to qualify for a 2 to 4 unit, You go through the pre-approval process with me. Going to require 2 years tax returns, W-2s, recent pay stubs, and then sufficient bank statements to show sufficient funds for qualification. But the best part about a 2 to 4 unit is, let's say, for instance, you're making $60,000 a year as a W-2 employee on a salary. You're going to occupy 1 unit. There are now 3 other units in that building that are going to generate rental income. Okay, depending on the bedrooms count and the size of those units, you can collect anywhere from $1,500 to $2,500 a month for those units. So let's just use an easy number of $1,500 a month of rent generated per unit. You have 3 units. That's going to bring you in $4,500 a month in rent. Okay, we take 75% of that $4,500 a month and use that to help you qualify. Okay, so now, which we're gonna have to edit this out, but I'll do the math for you just because I can't do it in my head. 4,500 minus 25%. So we're gonna take $3,375 a month and add that to your $5,000 a month salary. So now you jumped to $8,375 a month in income to help you qualify for your mixed use. Okay. Now, majority of the time, the rental income from those 3 units is going to cover the entire mortgage payment, including principal, interest, taxes, and insurance. And that's how you live rent-free in a multi-unit.
That is, again, amazing stuff. I'm sure, I don't want to say I'm sure a lot of people hear about it and things like that, but to hear it explained that way and broken down that way, I mean, yeah, it's good information.
Great information.
And so, are there differences between FHA and conventional qualifications, or are they about the same?
So that's an awesome question. I don't know exact date, but conventional within the last 2 years has changed their guideline about mixed use, which is a huge plus.
Right. To, what is it? It's 5%, right?
Yes. So 5%. Conventional within the last few years changed their down payment requirement for 2 to 4 units. Okay. It used to be 25% down. They have now changed it to 5% down as long as it is owner occupied. Okay. So FHA is 3.5% down. Conventional is 5% down. Now, this is very, very helpful with conventional because most people that are looking to purchase their second multi-unit have to utilize conventional financing because conventional financing will allow you to utilize the rental income on your tax returns for your first multi-unit in order to qualify for the second one.
All right.
So being able to purchase a second multi-unit with conventional financing, putting minimum down of 5%, is a very, very big help for people who are looking to build some sort of portfolio for multi-units.
Gotcha. Trying to think if there's anything else.
On those two?
Just in general, like FHA loan limits, I guess we can if you know those.
Ask if you can apply any grants.
Oh,
for multi-units, yeah. So is there any available grants that you can apply?
What about, can we use those for mixed use also?
I don't know about mixed use, but I know 2 to 4 units you can.
Okay. So John, are there any grants available for mixed use for 2 to 4 unit?
For 2 to 4 unit. So you can utilize the IDA grant on 1 to 2 units. Okay. IDA does not allow for 3 and 4 units, but IDA does allow for 1 and 2 units. So you can purchase a 2 unit utilizing the IDA down payment program, and they have 3 programs within itself, one being a $5,000 assistance, the other being $7,500, and the last one is going to be $10,000. So yes, you can utilize 1 to 2 units IDA down payment assistance.
And I believe I remember us having a conversation, you mentioning you guys, Neighborhood Loans, you guys have a pretty unique position with the IDA loans, correct?
Yes. So IDA does...
I'm sorry, not the IDA loans, the IDA grants.
The IDA grant, yes. The IDA grant. We were one of the top lenders that was signed up with the IDA program that allows us to underwrite the IDA loans in-house. So our turn times are significantly faster. So as our relationship grew with IDA, it allowed us leeways to where we can now underwrite these loans in-house, make the turn times a lot faster for you.
Which when a potential seller sees, we're using, IDA, or we're using down payment assistance, and it's an IDA loan, we can then go back and say, hey, we're writing that loan in-house so we can quicker close time.
Absolutely.
Yeah.
To speed up the turn time, we don't have to wait 60 days to close. We could still close in 30 days with IDA down payment grant. That will help your chances of getting your offer accepted.
Gotcha. Okay. All right, cool. I don't think I have any more questions. Anything else that any other information you want to give before we end it?
So I think we tapped into anything. But if we raised any questions, please reach out to myself, Darian, and we'd be happy to answer any questions. If you're looking for a multi-unit mixed use or just looking to purchase any single-family residence, Darian right here would be more than happy to help you out with your real estate purchase, and I'd be happy to help you out with the financing of that.
Yep, and obviously reach out to John. I mean, you heard all the programs that he offers, the DSCR, multi-unit, the 2 to 4 units, mixed unit. He's there in pretty good with IDA, so they write all the IDA loans, the down payment assistance. They write all those in-house, quick turnaround time. So reach out to John directly. See him for the money. See me to buy it.
Awesome.
All right. Cool.
All right, we've got